welcome to the program Agric on ARC and television, Abuja, Nigeria. I am Khadija. Today on the program, we shall be taking a look at the impact of microfinance on small-scale farming. Yes, when I mean this, I know what we understood as microfinance, and small-scale farming only means peasant farmers. And this is targeted at those peasant farmers who are farming for the market, of course the small markets around them. Now, we know that we have different microfinances around, but then the constraints are being location, getting to meet these farmers and the rest of it. Today we'll be assessing what in general terms has been the impact, that is to say that the positive and the negative impact. Before we move on and I'll be introducing my guest, I shall quickly take a short clip of what the topic tells. Stay tuned. Microfinance is positively related to agricultural production and shows a significant impact on output levels. Major challenges identified with credit access include unavailability of collateral securities, small loan amounts, and delay in the release of agricultural loans. Different studies on the constraints and problems faced by smallholder farmers in the country have revealed that lack of access to market information, poor access to credit facilities, little or no support, and high cost of farm inputs have been major hindrances to their profitability and productivity. It has increased the proportion of those having savings accounts in program and other microfinance institutions. Increased savings in those accounts implies better consumption potentials. The project has made beneficiaries engage with their enterprises. This likewise results in employment in these enterprises. The findings shows that microfinance bank loans and advances have a positive and significant long-term effect on Nigeria's economic growth. Therefore, the study recommends that microfinance institutions must be adequately harnessed and supported to attain their maximum potentials. However, this work indicates that microfinance credit has only short-run effects on agricultural sector output in Nigeria. These findings depict, among others, that the microfinancing hub of the financial system is capable of driving short-term investment needs of the agricultural sector. Availability of finance would go a long way in improving output and productivity in agriculture. Estimates suggest that availability of finance for African farmers could lead to an increase of over 300% of agricultural output from $280 billion to $880 billion by the year 2030. Welcome back. It's still the program Agric on ARC and television, Abuja, Nigeria, and I am Khadija Oluwatoyin. Today, our guest on the program is no other person, our in-house economist who has been taking us on each topic each week since the inception of the TV. Wow, is that not a big deal? It is, of course. Welcome to the program, sir.
Thank you for having me.
Yes, this week we shall, like I said, take a look at microfinances. First, let's start with that. When we talk microfinance, people feel it's just for those doing businesses that can, when they say microfinance, they tell you, I don't have the energy, I have to be putting in money every day and the rest of it. Generally speaking, what has been the impact of these microfinances to smallholder farmers?
Microfinance banks' impact on smallholder farmers cannot be overemphasized. If you want to look at the origin of microfinance, you will discover that microfinance is established to be able to cater for communities and individuals in far-flung areas and rural areas that will have need for banking transactions, and to be able to also increase an inclusive financial transaction that is called financial inclusion by the Central Bank of Nigeria. And that is why we have so many microfinance, almost 1,000 if not more of them, scattered all over Nigeria. Most of these microfinances banks are in communities, are in agrarian communities and they have been doing tremendous work meeting up with the needs and demands of these communities. One thing I want us to know is that if you look at the history of microfinance, it didn't start today. It started years ago, even when banking evolution was taking place in Nigeria. When you look at the first banks that first came to the country, like Barclays Bank, that turned to Union, you have First Bank, which is Bank of British West Africa, and all the other banks. There is a particular bank then that used to cater for farmers. It was introduced by an individual. Then it was called Agbomagbé Bank, and that is a bank that now became Wema Bank of today. We also had a bank then that was called Cooperative Bank. It metamorphosized over time to become a merge with what we call Sky Bank then, and eventually Polaris Bank today. Why am I bringing us to the history of small-scale banking in Nigeria? Is because of the impact that those banks have had in the agrarian communities that has now culminated into their big size and becoming even larger than ordinary microfinance banks. We discovered the history of banking to ensure that most of the deposits then in these banks that I mentioned were collective contributions of farmers in those agrarian areas that built the deposit base of these banks and made them to grow from being micro to a national bank, and even eventually going international in some cases due to the banking reforms going on now. So the impact of microfinance on small-scale farming is very, very, very tremendous, in the sense that because microfinance is the first right of access to banks in those agrarian communities by those farmers. Two, because of the flexibility of their operation, and because of the easy access to be able to access loans in those microfinance banks, it has endeared the farmers to them. The smallholder farmers can easily partner with such banks to be able to get to what they want and be able to achieve their aim. And the microfinance bank also leverages on the farmers' contribution to ensure that they continue to survive and serve other communities and other customers as well. So we discovered that smallholder farmers or small-scale farmers have benefited tremendously from microfinance bank, because if you look at most of the big banks and the commercial banks might not be able to directly or immediately meet the needs of these smallholder banks because of their risk acceptance criteria, which the smallholder farmers might not be able to meet. So this makes them to fall back on these microfinance banks, who always, most of the time, helps them to be able to meet up with what they need at every point in time. So their impact has been tremendous, and we can say that the banks, the microfinance banks, have been able to help a lot of smallholder farmers across Nigeria.
Okay, looking at the area of course, whatsoever that has a good has its bad side. We know that these loans are soft loans given to farmers. What happens, or how have they been able to cope with the area of people, cutting away with the monies and not repaying and the rest of it?
Microfinance banks, based on their mode of operation, try to ensure that they get to the grassroots. Some key know your customer elements that some big banks overlook are not always overlooked by the microfinance banks, because they are very close to those communities. Customers, farmers, smallholder farmers that come to have access to facilities are known even right to their homes, and they ensure that even those that are going to come to guarantee them are also known as well, so that if they cannot reach the farmer or who has taken the loan, they can always reach the guarantor. And they also ensure that they are always at the customer's place at every point in time when the need arises for those loans to be repaid. So what I can say is that those microfinance banks try to minimize losses because they are always in contact with their customers, and they are always the first one to see whether there will be a risk of default or not, and also try as much as possible to provide solutions to it before it gets to outright default. So they try as much as possible to mitigate against default by ensuring that they are close to those customers.
Okay, we know that an average Nigerian peasant farmer, smallholder farmer, is saddled with so much responsibility, and then they tell you they have enormous problems from road to different infrastructural issues. Has this microfinance been able to solve or sort these issues to an extent?
To a large extent, the microfinance banks have been able to help the smallholder farmers to grow capacity within their sphere of control. When I say sphere of control, I mean that they might not be able to do roads for the agrarian community because of capacity, but they ensure that the farmer is able to access enough to be able to grow his business, to be able to do the planting, and also ensure that they are able to buy what they need for their farm to grow. So they are like a first point of call to the farmers to ensure that the other logistics aspect is left for the government or the local government to be able to do. But the microfinance banks ensures that the farmers are able to access enough funds or capital to be able to inject in their business and be able to grow enough for their business as well.
Okay, so what's your word for a company? I know you have a company that does this. Has it been like in bringing down to the FCT?
In FCT, for example, microfinance banks are trying their best to ensure that they meet the needs of the smallholder farmers, and to ensure as well that they meet the needs of their immediate customers. But my advice is that for a smallholder farmer that might not have the requisite collateral, or that might not have the requirement needed by the commercial banks, that they should approach the microfinance bank and partner with them, because they develop ingenious modes of loans to be able to reach out. Their loan application is based on need basis. It's on need basis. They will look at your farm, they will look at the business you are doing, and be able to tailor a loan that will be able to meet up that need without necessarily bringing collateral. Or they do it in a way of a pool. They bring a number of farmers together, grant them this facility while they guarantee each other in the process, and they ensure that they become the monitoring officers of those loans. The farmers monitor themselves to ensure that there is no default among them. So the microfinance business in Nigeria has grown to the extent that the farmers can approach them. Some of the microfinance we have today, some have even aspired to become a commercial bank because of huge growth and fast movement of their businesses. So I will encourage every smallholder farmer that might not meet the criteria of commercial banks to approach the microfinance bank. Their interest rates are also moderate to the extent that the farmers can still take short-term loans that is well agreed and still be able to break even and even be profitable.
Okay, so what are the problems of microfinance in Nigeria? You talked about them being closer to the people.
Yeah.
Hence the issue of should I say taking away these loans and the rest.
Yeah, challenges. Yeah.
Part of the challenge. So what are the challenges?
Yeah, the microfinance banks, they have a lot of challenges. One of which is human capital deficiency, because you discover that most microfinance banks in Nigeria can only thrive when they give loan facilities to customers, and that is where their profit margin comes in, because they are not ingenious enough to be able to venture into other areas of investment because of the limitations given to them by the central bank. So, and also because of the situation of the country, they cannot be able to accrue savings deposit from their customers to the extent that it is from those savings deposit that they will give facilities to their customers. So in the process, they even touch not only their customers' deposit but even their own capital to be able to meet up with demands of customers. Why I say that one of the major problems they have is human capital deficiency is that some of these microfinance banks lack capable risk asset managers that can assess risk to the extent that it will not lead to the stage of default. And that is why, if you look at a year ago when the central bank closed some microfinance bank, it was because their loan to deposit ratio is below the threshold, and some of them have even gone to bankruptcy because of bad loans that were not recovered. So the major problem they have is deficiency in human capital, and also reduced or low capital base, based on the fact that most Nigerians today do not bring their deposit to microfinance bank because of lack of trust. They prefer to go to the commercial and the big banks that they feel their money will be safer with. So because they cannot access such deposits or like the commercial banks, so they have to fall back on the mega deposits they get from their savings customers as well as their capital. And when they use those funds to give loan facility that is not properly articulated or secured, it leads to a high rate of default, and it also eats deep into their capital. And some of them, they have with that gone into liquidation.
Okay, yes, quickly we'll take a break. I know you're following so many questions to be asked, and we'll do that shortly after the break. Stay tuned. Welcome back. It's still the program Agric on air, saying television, Mabushi, Abuja, Nigeria, and we've been talking on the impact of microfinance on small-scale farming. We've heard so much. We've been told the advantages to which these microfinance loans go a long way in, supporting small-scale farmers, especially those in the rural areas. Yes. Welcome back to the program, sir.
Thank you.
Sir, quickly, let me take the very last question where one of our observers said, why do farmers prefer to go to these big banks, in quotes, rather than go to microfinances?
There are two major factors or reasons why some farmers, some smallholder farmers believe that it's the big banks or the commercial banks that can help them out. One is that the interest rate of the microfinance banks are far higher. They are more than single digits. The interest rates are far higher, more than single digits, which can impact on the farmer's profitability on the loan. Because any loan that a farmer assesses that is more than that is a double-digit interest, that has double-digit interest rate, can impact negatively on the profitability of the farmer. The second aspect is the tenor, the loan tenor. Because of the kind of funds that the microfinance banks handle, they are short-term funds, so they tend to give shorter terms for their customers to repay their loans. And we know that an average farmer in Nigeria, if you look at the planting season, right from the planting to harvest, could take a minimum of 6 months and another additional 3 months for other logistics and sales before a loan can be repaid. But we see a situation whereby, because of capacity, some microfinance banks might not be able to give loans for more than 3 to 6 months. So the tenor also could be a challenge for a farmer to be able, why, and the reason why it's not approaching the microfinance bank. So when we look at the interest rate that is normally or naturally high because of the source of fund of the microfinance bank and its short tenor, it could deter a farmer from going to microfinance banks.
Okay, you talked about some possible, problems facing, the microfinance banks. What are the possible ways to ameliorate these issues?
One thing that is very important is that the regulatory authority, which is the Central Bank of Nigeria, needs to look at the peculiarities of the microfinance banks and where they are operating from, to be able to look at how to monitor and regulate them. Some of these microfinance banks are where the access ratio is far lower than in some other places. For example, a microfinance bank that is in a rural community cannot compete favorably with a microfinance bank in the state capital, for example, or in Abuja, for example, because people in Abuja or in the state capital can have larger sources of funding to be able to deposit in the microfinance bank and do big transaction businesses with them that can aid profitability. That cannot be said in communities where the access is limited, or the kind of funds and deposit that they have can also be limited and affect their operations. So that is why I believe that microfinance bank, even despite the categorization of banks to international, national, and regional, microfinance banks too should be categorized in the sense that there should be state microfinance bank, there should be community-based microfinance banks, and their share capital and mode of operation should be flexible. And one should look at the peculiarity of where they are operating from. That's why if they are segmented, it will help the microfinance bank to develop at their own pace. For a microfinance bank that is not in the state capital, it can be categorized as a community microfinance bank. With that, their benchmark or requirements by the CBN will be a bit lower than a microfinance bank that is a state microfinance bank. So this categorization can help the microfinance bank to develop at their own pace, just like the international, national and regional banks are developing at their own pace, so that we will not have incidences of microfinance bank closing shops or being closed by the central bank because of capital adequacy ratios at every point in time.
Okay, you talked about part of the problems to be the short duration of time as to loan repayment. Knowing how agriculture works, we know that, of course, if you're planting, you're in planting season, for example, melon, you know that if you're getting a loan to plant melon, you begin your planting now, and then before you talk of harvest, it's till like July, August.
That's about 6-7 months.
So, is this short-term thing sort of part of the policy, or there's something that can be done or advised?
For banking sector in general, there is what they call matching. Matching is the sense that the kind of deposit, the source of deposit you get will also match the kind of loan that you are going to give with such deposit. If you have a lot of customers that are giving you 30 days deposit, 60, 90 days deposit, in Nigeria, you have very few customers that give 365 days deposit. So when you have matching of deposit, it gives you a limited capacity or flexibility to be able to give out loans based on what is on ground. Because when you do not obey that law of matching, it can affect your fluidity or your liquidity, in the sense that if you have 10 billion, for example, that are for between 60 to 90 days, and you are giving out that same 10 billion for 1 year, So when customers recall their funds, if you feel they are going to renew and they do not renew and they recall their funds after 60 or 90 or 180 days, for example, you might not be able to meet up with their need because you still have funds out that have not returned. So that is why the banks generally, and the microfinance bank inclusive, also obey that law of matching, that the pool of funds that they have, the tenure of their deposits will match the tenure averagely of the loans that they give out. It's not as if they cannot give out loans that exceed those tenure, but they are always minimal, so that they will be able to meet up with customers' demands when they come. So it's the matching that is the problem that makes microfinance banks, just like all the other banks, to look at the tenure of their deposits based on the tenure of their loans. That's why in Nigeria, even commercial banks, most of their loans do not exceed 1-2 years, while the ones that are massive, that are backed with other things, collaterals and the rest, can now go for 5 years or thereabout.
Okay, thank you so much for the clarification. Thank you for having me on the program this week.
Thank you for having me.
Yes, that's it for the size of our package this week. Join us again, same time, same station next week as we bring you another educating episode. From here, I'm Khadija Oluwatoyin saying bye for now.